There's one thing that no investor or no human wants to go up against. Now, oftentimes people don't know, or investors don't know, they're going up against this thing, but in fact, many times they actually are. And if they just knew that they're going up against this one thing, and if they knew the probability or the odds of winning against this one thing, then it would completely reshape the way they invest. So the question is, what is this one thing? Well, the one thing is math. Or said slightly differently, the one thing is probability. You don't want to go up against probability, right? You don't want to put your money against something if you have 1 out of 9 times to win and 8 out of 9 times to lose. That means your winning chance is only 11%, and your chance of losing is 89%. Well, that's in fact what people are doing, but even worse. And so what I want to show you is how, if you just understand what you're doing with your money and how you're investing, and how oftentimes people go up against the wrong side of math or the wrong side of probability, you can start to see why investors themselves have such a hard time growing their money over any time period. Hey everybody, this is RC Peck, and this is my weekend podcast. And I'm just going to call this podcast Simple. Now, this may not be the title that I give it on YouTube, or it may not align with the subject line, but really what's behind this conversation with you is the idea of simple, or the idea of being straightforward with what we do, with what you do with investing. And I want to show you a few charts. Actually, I'm going to show you 4 charts to be specific here, and show you how, if you can just look at things in a very straightforward way and keep things very transparent and keep things very simple, then you're going to grow your money much, much more effective than, say, every big box advisor out there and every conventional advisor out there. Because after all, what big box and conventional advisors are doing is they're wanting to beat the market, or at least not lose that bad to the market, so you never take your money away from them. And what I discovered over 2 decades ago is all big box and conventional advisors, all they're doing is creating a complicated, complex approach to mirror the market minus their fees. And depending on who your advisor is, whether it's a big box or a conventional advisor, fees are anywhere between 1 to 3%. So they're going to deliver you the market's performance minus 1 to 3% over time. Which really means, and this was my epiphany in the early 20s, well, you don't really even need an advisor if that's all they're going to do. And in fact, that is all they do. So let's take a step back and look at kind of what we're doing and how some people are really going up against math. So there are 9 sectors, 9 main sectors that make up the S&P 500: energy, staples, healthcare, utilities, materials, technology, industrial, finance, consumer. So these are the 9 main sectors. If you put your money in one of them, say energy, you have an 11% chance of beating the overall market, right? Because these are, 1 out of 9 sectors. So 1 divided by 9 is 11%. So the odds of you being right with just kind of picking them without using some math, or in my case, looking at the price charts, then you're going up against math, you're going up against probability. And all things being equal, you don't want to do that. But here we have the 9 sectors that make up the S&P 500. So the question you have to ask yourself is this sector outrunning the overall market? Because if it's not outrunning the overall market, there's just no reason for you to ever be in the sector. It's a losing person's game. At a minimum, it has to be running faster than the sector. So look at this, and I'm not going to show all 9 sectors, but here's the energy sector going back 4 years. And what you're looking at here, and I want to be specific, is you're looking at the energy sector in relationship to the S&P 500. So if you see this line falling, that means the energy sector is doing worse than the S&P 500. It's literally underperforming the S&P 500 on a relative basis. So as your brain can see, it's going from upper left to lower right. So that means the energy sector has been underperforming the S&P 500 for 4 years. So the only reason someone would want to have been in the energy sector if they had this price chart is maybe they were day trading it or position trading it or swing trading it or some sort of trading. And again, all things being equal, trading over time does not work. So you don't want to be in the energy sector until it's outperforming the S&P 500. I mean, this should make sense. Yes? So here's the second sector. Again, I'm showing 3 of them. This is consumer staples. These are things you have to buy. You have to buy food and groceries and Band-Aids and shampoo and things that are not exciting. You just buy them because you have to. It's the consumer staples sector of the S&P 500. And if you look at this, you can see that, yes, sometimes it outperforms, sometimes it underperforms, sometimes it does much better than the market, sometimes it does much worse than the market. But generally speaking, it's just kind of going zigzag sideways. There's no clear direction, right? With energy section, it's very clear that the energy sector has been underperforming the S&P 500 for 4 years. But with staples, it's kind of like sideways. Yeah, I can't really tell if it's good or it's bad. I mean, sometimes it is, sometimes it isn't, but there's no clear direction. So there'd really be no reason to be in staples because you want math, you want probability, you want the price charts to be behind you, right? You want the wind at your back. And with staples, sometimes it is, sometimes it's not, and it's very frustrating. And with energy, it's clearly not. So consumer staples is one of the 9 main sectors. And then we have healthcare. And if you look at healthcare clearly over the last 4 years has been beating the S&P 500. Again, when the price chart goes higher, that means that sector is outperforming the overall market, or in this case, the S&P 500. So if you ever were to want to beat the market, you're going to have to add volatility or potential volatility. Now, you can, but you have to have the price charts on your side. And in this case, this is healthcare divided by the S&P 500. So when it goes higher, healthcare is outrunning the stock market. But now you're in healthcare and you only have an 11% chance of beating the stock market, which again, if it's moving up faster, then that's fine. But you're still at a disadvantage statistically or mathematically, and it can move against you. So what I noticed is if you want to beat the market, why don't you just be the market, right? Just be the market, but be the market in a specific way that you can actually outrun it without having to increase potential risks of being in a sector or a subsector or an individual stock. Because if you buy into an individual stock, the assumption you're making is that individual stock is going to outrun the sector, and that sector is going to outrun the market, which means you are getting into a lower and lower and lower chance of beating the overall market. Now, yes, this can be done. Yes, you can use price charts, but for 99% of investors, including professional investors, it should not be attempted. And if it is attempted, it should be attempted with 10%, 15% of their overall portfolio. But now look at this. I want to show you one last chart, and this is my last chart I'm going to show you. This is healthcare relative to 200% of the S&P 500, right? So you can buy the S&P 500 with a leveraged position where if the S&P goes up or down 1%, you can have an ETF, an exchange traded fund, go up or down 2%. And now when you look at healthcare going up against the stock market at a leveraged 2x position, you can see it's much less favorable. In fact, from the middle of 2011 to the middle of 2014, it was absolutely underperforming. And for the last year, it's been slowly outperforming, but not to any great, level. And if you look at all 4 years, it's like, okay, yeah, generally speaking, it underperforms 2x the overall stock market. Now, here's my point. This is super straightforward, or at least this is one of my points. This is super straightforward. You can beat the market. You can lower your volatility. You can lower your risk by actually being the market and being the market in a leveraged position. So literally, it's lower price volatility, which some people call risk. It is lower risk because you're still having your money divided between 500 of the best publicly traded, largest traded companies on the planet. It is not trivial to get into the S&P 500. And every year, the S&P sheds off about 3 or 4% of its companies and replaces them with stronger companies. So every year, it's getting rid of the weakest ones and bringing in 3 to 4, sometimes even 5% of new companies. But historically, they shed off about 4%. So they're always refreshing themselves with stronger companies. They're always getting rid of companies that are not as healthy. And so you can beat the market by being the market with a little leverage. And I know that some people are going to freak out and be like, whoa, leverage is dangerous. You can lose everything with leverage. No, that's actually not true. Because of the way you can invest in an exchange-traded fund or a mutual fund, A, you can never lose more than what you actually put in, but it is actually safer to be leveraged over 500 stocks than to go into an individual sector, which is actually much riskier, though it may not feel it, but mathematically it is. And I really wanted to make sure you saw these because a lot of times people believe, including you, if you're human and born on planet Earth, and me, as I am human and born on planet Earth, that more ticker symbols and more companies and more sectors and more asset classes and international and domestic and emerging market and value and deep value and growth and whatever is a better way to grow money. But actually, it's not. It's just a more complicated way. Pretty interesting stuff. Now, the takeaway, and I said it before, but I want to say it again, the takeaway is you beat the market by being the market. But the way you be the market is important. And that's what my strategy market probability does and shows people what to do. And for the last 20 years, for the last 10 years, for the last 5 years, for the last 3 years, for the last 30 years, for the last 50 years, for the last 143 years, that's how far I back tested it. It is super straightforward. It's super easy. It's super simple. And it does what people want to grow their money most effectively. So beat the market by being the market. Now, there's a couple pieces I'm leaving out because we don't have time. One is managing stop losses, and market probability manages your stop losses. And here's the crazy thing. Even when people know to do this and they see the content and they see the information, they still don't do it. There's just a huge, deep desire in the human brain to not do what's straightforward, to not do what's obvious, to not do what's simple. And that's why a lot of times clients just say, hey, RC, can you just please do it for me? Just knowing it's being implemented properly, please do that for me because I want the benefits of market probability. I want the benefits of knowing it's getting implemented properly. I'm so glad you guys are with me. Thank you so much. This is my weekend podcast. It's been a week now since I've been back from my family vacation. And that first week back, I'm eating normal again. I'm not eating 2 desserts at each meal. A funny thing my kid said at family vacation, he said, where's our breakfast dessert? And I just love that. Of course, there should be a dessert at breakfast. So thanks, everyone. This is just another step in helping you protect your future and your portfolio. Until next time, this is RC Peck. Hey, everybody, thanks for being here. Thanks for listening to my podcast. I love putting these together and showing you how, the power of price charts and the power of math and the power of probability you can use to your advantage to grow and protect your money over really almost any period of time. And for some, knowing what to do is not enough. And just simply having someone implement it for them is the difference that makes a difference. And if that's you and you've heard me talk about this time and time again, then the answer is super straightforward. We can do it for you, right? So if you know what to do, or if you see how this works and you're not doing it, then have someone do it for you. There's no gain in knowing what to do but not doing it, right? Nobody wins in that way. including your future and your choices and your kids' future or your grandkids' future. So if you're curious about having someone actually implement this and do it the right way for you on your behalf, the next step is super straightforward. Simply just reach out to us. You can just reach out to my assistant, Patty at Fearless Wealth, and we'll get back to you. You just give us your name, your email, your phone number. Well, we'll have your email, and we'll just talk to you, see if there might be a fit. You guys take care of yourself, and I'll speak to you soon.